Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. The Bank of Canada has cut its key interest rate by 25 basis points to 4.5%. This is the bank's second consecutive rate cut, and they've signaled more cuts ahead. Joining the show today to discuss what the latest rate cut means for Canada's economy and for you is renowned economist Don Drummond. Don has held several senior roles at the Federal Department of Finance, where he was responsible for economic analysis, fiscal, and tax policies. Don speaks with host Pamela Ritchie to dive into what lower interest rates could mean for the CAPEX story, and might lower interest rates spur further investment into Canada. They'll also unpack inflation, wages, mortgages, immigration, and more. Let's get to it. Today's podcast was recorded on July 25th, 2024.
It's been a little over 24 hours since we've learned about this rate cut. So I wanted to skip ahead a little bit to one of the things that you noted in some of your comments, which was the slack in the economy that exists that didn't exist, and to an extent where that fits into the story. You've said before, whether you're going to buy a house, is the interest rate story is always going to be a massive piece of the story, but it's actually more about whether you have a job. Talk about the slack in the economy.
I've always wanted the Bank of Canada to put a lot more emphasis in their reports on the so-called output gap. So the difference between actual output and potential output, because that's their measure of slack in the economy. And it's there, but you have to look for it pretty hard. So they estimate that the demand in the economy is between 0.75 and 1.75% below the potential output. That's actually pretty significant. That indicates there's quite a bit of softness in the economy. And they could have made that a lot more explicit. That is the bottom line of why they think the downward pressure on inflation will continue, because they're projecting economic growth for the remainder of this year and throughout 2025 to be around 2.25%, which is above their estimate potential. And you may well say, how do you get downward pressure on inflation if growth is going to be faster than potential? And the answer is there's a considerable amount of slack in the economy. That will be decreased somewhat, but it will remain. I just wish they would put that in a table or chart and to be a lot more explicit, and I think we would understand it more readily.
What would it look like on a chart?
It would show that we actually aggregate demand for quite a bit of time was above aggregate supply. So we had excess demand. That's why, there's all kinds of reasons why inflation took out the supply chain, other things. The Russian attack that cut off grain had an effect on oil and natural gas markets. There's all kinds of factors, but it was kind of the good old garden variety. In Canada and many other countries, aggregate demand was simply too hot, and a lot of that was aggregate demand didn't get killed by the pandemic to the extent that many authorities feared. So in a sense, they overstimulated through monetary and fiscal policy. So the chart would show we were in serious excess demand pressure 2021 and 2022. The interest rate hikes were justified. Somewhere maybe about 2 quarters ago, we were about balanced, but with the economy being relatively soft in the last 6 months, it would show this emergence of a significant output gap. In other words, the demand in the economy, largely from weak consumption, to some degree weak business investment, is slower than it should be relative to what the supply capacity is doing.
So let's talk a little bit about that business investment, the CAPEX discussion there. We mentioned that in the introduction. There's a slow start. It seems to be taking a while. What could jumpstart it? We actually thought cuts would be it. We're now into the second cut. Where is it?
I don't think that business investment is driven that heavily by interest rates. If they see an opportunity for profit, let's face it, they can borrow the money. A lot of them have internal retained funds. They could drive it themselves. Part of it is, despite this lack of business investment, the corporate sector writ large in Canada is not threatened. Corporate profits are quite high. The economy is not booming. They're not investing an awful lot, but the corporate sector, and that's not to say all sectors or all companies, but you look at the level of corporate profits, share of the economy, the absolute level, look at it relative to other countries, look at it relative to history, they're not doing that bad. So in a sense, a little bit, it's a stretch, but we've kind of noticed this in economics, the lazy manufacturers hypothesis. It's sort of the Canadian dollar is weak. you know you're going to get a profit in Canadian dollars. Why work all that hard? And I don't think that's the attitude of most businesses, but I don't think a lot of them feel that they're compelled to invest an awful lot more. And I don't think the interest rate's the thing that's holding them back. We used to have a corporate tax advantage, but now with the changes in the United States and other countries, we no longer have advantage, but we're not at a huge disadvantage. Businesses wanted faster write-off for their depreciation. They've largely got that, so that's not holding them back. It's a bit of a mystery, particularly in sectors where they do have the retained earnings to drive business investment up, and they're not doing it. And particularly our weakness is in machinery equipment, not so much in businesses, and particularly in software.
Interesting. So, I mean, we're still kind of waiting for whatever that's going to be to spur that ultimately. Let's talk a little bit about the discretionary spending, the story of Canadians struggling. Ultimately, that's why they're bringing rates down. It's overly restrictive, or it has been overly restricted. But you don't see, talk to us about the yield curve. You are not seeing a recession around the corner. You're not seeing, in fact, you think probably this yield curve inversion will unwind.
Well, just to define it in one term, so the Bank of Canada's rate now is 4.5. If we look at an example of a 5-year bond rate, it's at 3.4.
Right.
That's very unusual. You would expect a 5-year bond yield to be above the bank rate because time means uncertainty. And if I'm going to commit money to you for 10 years, I'm going to want some kind of premium to hedge against something bad that might happen, and we're not getting that. A lot of people have said when you get an inverted yield curve that is a predictor of a recession. I think that's a misreading of the numbers. Normally when we've had an inverted yield curve is because short-term interest rates have risen very high, and we have an inverted yield curves where interest rates at the short end have gone up, but are not particularly high, but long-term yields are just quite low. And that's the unusual feature of where we are right now. I don't think that predicts that we're going to have a recession. I think at some point we will revert to a positive yield curve, but that at some point, let's say the end of 2025, that Bank of Canada rate, instead of being 4.5, it'll be at the midpoint and neutral, 2.75. So there's 175 basis points more cutting, and we probably won't see the bond yields go down any further, and the whole yield curve will right itself by short-term rates going down rather than long-term rates going up.
So there's certain things are kind of pricing in what's coming up in the next year. What is coming up in the next year? We heard a more confident tone probably out of Tiff Macklem. He's on the road. These cuts we're in an easing cycle. Looking out to sort of a year from now, expect rates to come down quite a lot, and for everything to be rosy.
We heard a more confident tone unambiguously on the inflation front. A little shakier tone on the economy. He's definitely expressed more concern about the weakness in the economy, particularly the weakness in consumption that he did before. He's again expressed the worry going forward of these multitudes of people who are going to have to renew longer term mortgage rates. But I will say on that front, so far, the household sector, the mortgage holders have proved to be quite resilient. We're not seeing very many of those fixed term mortgages as they've come up, or these variable rates who are having to pay higher and higher amounts, get out in arrears, never mind default. No doubt they're squeezing very painfully elsewhere. Holidays, car purchases, which are quite weak, even discretionary, probably not going to the movies as much as happened previously, but they are in large continuing to pay their mortgage rates, i.e. much higher mortgage rates.
This is the question about the rating for Canada, how Canada looks to outside investors. Is the AAA rating of the Canadian federal government in jeopardy at all?
Well, most things in life are relative, and that is too. I would say that we're in trouble fiscally. We got a large debt. It's around 40% of our GDP, but virtually every developed country in the world would kill to have that. I well remember when I was heading the fiscal policy in the mid-1990s, we used to say, thank goodness Italy's in the G7, because when we did the debt and deficits comparison, we were off the scale with everybody else other than Italy, and now it's flipped around. We're kind of still off the scale, but we're on a better tune. The US, the United Kingdom, France, all these countries are in deep trouble, much deeper trouble than Canada. So I think if you're a bondholder, if your bond rating agency, as troubled as you might be by the debt in Canada, we look better than most other countries.
So do we see flows that follow on from that fact?
Yeah, I would think our bond yields have to look quite promising. The Bank of Canada, as you said, their outlook is very rosy and has to by definition. Let's face it, if they didn't show a rosy outlook, they'd put up a sign and say, we are failing on the policy front. They have to show their policy front is ultimately going to be successful. But I think our conditions look pretty good. The one thing I really like to see happen would be what you just said, stronger business investment that would increase our potential output. The Bank of Canada makes a big point that they think our productivity growth rate was strengthened in 2005. And I looked and I could never see a reason given for that.
2025?
So that seems to be a little bit wishful thinking on their part.
Okay, 2025. Another question, this goes to, the nuts and bolts of our economy. Are rising freight rates an indicator that inflation might tick higher over the next few months? I mean, there are lots of indicators, obviously, that are showing inflation is coming down, but there are also lots of people who feel that inflation is not finished with us.
Well, this is why the economists have the ledger in two hands, because you can see it everywhere. I come back to those wage numbers. The labor force survey has wages going up by 5% a year. Even if we have productivity of 1%, that's a 4% increase in unit labor costs. That is not consistent with 2% inflation. The Bank of Canada noted that their core measures of inflation have come down, but they're still in the 2.5% range. And a lot of people are celebrating the release this morning of the preliminary estimates of GDP in the United States and pointing out the consumer deflator, the core one, has come down, but it's still up 2.9%. That's still a long way from their target. So inflation is proving to be sticky despite the economy slackening. So there's no shortage of things to worry about if you want to worry about the inflation front. It's coming down. It's a lot better. Let's face it, we're a long way from the 8% we were a while ago, but it is not back at target, and there could be ongoing problems.
When we come back to the productivity discussion there, and how you don't see exactly how it will happen, but the Bank of Canada is pointing to it as something that should be in the offing in the months ahead. Bring in the technology discussion for us. How do you see that being shaped? I don't know if Tiff Macklin referenced that exactly. I was reading his notes, but
he didn't. He didn't say very much about productivity. As indicated, he didn't give any reason why he thinks it should increase. But if we do our international comparisons, at one point, up till about 10 years ago, we were pretty much investing on par with most other developed countries. It's been the last 10 years has got weak. It sort of started with the decline in oil prices in the second half of the 2010s, because we're pretty laden in that sector. But if you break it down, it's machinery equipment is where we're most vulnerable. And if you break down machinery equipment, it's on the IT, the software side, where we underinvest relative to other countries. So we're not quite as innovative as we could or should be.
When you're looking at the bond market, ultimately, that's what mortgages are priced off these days. You're mentioning the 3-year bond and where we've seen rates come down quite significantly. And you said maybe they won't come down anymore, actually. It's probably done.
Well, I still hold to the belief that at some point the yield curve has to be positively sloped. And again, if you're going to lend somebody money, if you're going to lend them for a long term, you better ask for a premium, because there's a lot of uncertainty and there's some risk that you might not get your money. And the longer the term, the more that risk is. So I think as we head to a bank rate at 2.75, we will see the longer term bond yields above that 2.75, maybe 100 basis points above that, would suggest that they won't change very much from where they are now.
The Bank of Canada did reference immigration, got into the discussion of it, was careful to sort of look at sort of a longer horizon, I guess you'd say. Not looking so much.
They started off with their analysis looking at the longer term, and they said, well, the immigration adds to the supply capacity. There's more people, and on balance they work, but also they add to demand. And they thought in the longer run they'd be roughly balanced, so no really inflationary impact. But in the short term, they were very soft in their words. But in the short term, they said unambiguously a positive impetus to inflation, particularly for housing prices and for rent prices. And boy, do we ever see both, particularly the rent prices, which have gone up enormously in Canada in the last couple of years, coinciding with the sharp rise in immigration. Now, the Bank of Canada notes, and it's reflected in there, we've already seen a significant decline in the targets for the non-permanent residents, both from the workforce side and from the student visa side, and that is factored into their forecast. But still, you think, like, over the last year, the population in Canada has increased 3%. There's almost no country in the world that's having population growth of that magnitude. Our more normal population growth is 1%. We haven't seen 3% since 1956. And that was when we took in the refugees from Hungary and other Eastern European countries. And that was just a one-year event.
I mean, it's something for governments to sort out, certainly, but it's just interesting to look at it from the perspective of the Bank of Canada and where they ultimately are seeing it, either in an inflationary way or adding to the economy itself. What do you think of bigger cuts along the road? I mean, it seems like things are smooth and steady and they can continue with this. And as you say, economies have been remarkably resilient, actually, with higher rates. Any reason for bigger cuts? We're starting to
and the governor laid that out. He's clearly expressed greater concern in yesterday's report than previously in the softening of the economy. Right. So we've had a couple of particularly weak retail sales numbers. So if we see a few more of those, or if we saw employment decline, and we consider to see the core rates of inflation come down, I don't think there's any reason. They're going to do at some point another 175. Does it have to be 25 every meeting or 25? No, absolutely not. They could go at a much faster pace, and a softening economy would be the trigger to do that.
Would reducing regulations increase business productivity? To get into sort of the details of how that productivity might come about, and investment flow into Canada?
Well, we'll just start off with the one that everybody always talks about, but nobody does anything about, the interprovincial trade barriers. That's the most ludicrous notion. We establish free trade agreements all around the world, but we don't have a free trade union inside Canada. And the CFIB just put out the latest in a long series of measures of how much our gross domestic product would rise if we eliminated them. On the bright and minor side, we do have a detente between Alberta and British Columbia on British Columbia wine. So we'll celebrate that for the product and for the message that sends, that maybe there's some hope that we can work out these things. But that's a very small example of a lot of different things that could be changed. And it flows in the labor market. For example, an Ontario construction worker cannot work in Quebec, although oddly enough, a Quebec construction worker can work in Ontario. And that was from pressure from Ontario construction companies who couldn't get the employees that they wanted. So it's not even a symmetrical relationship. That is pretty bizarre. We're getting a lot of controversy right now as we move towards cleaner growth. Oddly enough, we need to do more mining, the precious earth minerals, to support the clean growth. And we're looking at 15 to 20 years for approval process in Canada. And that's everything going quite well. We're going to get overrun by every country in the world that has precious minerals if we don't do something about that. And that's not easy to do because there's so many different stakeholders. Part of it's federal, part of it's provincial. Of course, we very rightly have to bring in Indigenous perspectives. A lot of it is on Indigenous land. So I'm not saying we could just wave a magic wand, but that's an area we absolutely have to do better in.
Yeah. Do you see that happening?
I do. I think the motivation just has to be perceived as being so strong. We want cleaner growth, and it's totally dominated by China right now. The 70% of the resources are dominated, 90% of the processing. And so often we talk about China as a threat, and we just got the attention yesterday of the Russian and Chinese military, the aircraft activity. But ultimately, it may be the economic control. As countries around the world are pivoting to clean growth, they entirely dominate that market, and yet we have the resource right here in our ground, but we're not setting up a process where we're in a clean, sustainable fashion where we can access it anytime soon.
Yeah. Okay. The question here, this is about the Canadian dollar. This is always the concern as interest rates get cut, that you see sort of a rocketing downward of the currency itself vis-a-vis the U.S. But we've also got the U.S. thinking that they're going to cut too. So anyway, just speak to sort of the currency story that as you see it.
Well, let's say, first of all, the primary driver would be the difference in productivity between the two countries. And we've long had a 20% or so efficiency and productivity vis-a-vis the United States. So let's face it, we don't merit a dollar stronger than about 80 cents US, and that's more or less what we've got for a long time. That productivity gap is even widened. So it's not just the interest rate differential. The interest rate differential is probably a fairly small contributor relative to that productivity differential, and that's getting bigger rather than smaller. And as you said, the Federal Reserve Board is probably not going to be that far behind Canada. But I have to think the Bank of Canada and the rest of us too probably shouldn't be too worried about the dollar. It's sort of residual in this. And if our productivity is that weak and our competitive position is that weak, well, that's what we're going to get. We're going to get a weak dollar. Helps in some areas, but good luck if you want to go to the United States or buying imported goods.
Yeah.
And it kind of comes back and hurts you too, because 70% of our machinery equipment is imported. So as we need to do more of that, it becomes more expensive because we're paying for it in Canadian dollars, but we got to buy a product that's priced in US dollars.
Right, in sort of the ramp up. But for that's already ramped up and is ready to be sold, in theory it helps. But yeah. Okay. You see how the balance of that ultimately works out. When you talk about sort of the idea of competition in this country, it's something that's being discussed a lot about. We're seeing regulated industries start talking more about AI. We were talking about it actually yesterday with former ambassador to the United States for Canada, David McNaughton. We've been discussing just the idea of where Canada fits in terms of a competitive story vis-a-vis the United States. What do you see on the competitive front inside our country? And then we can go further afield. Any movement?
Well, not really. Historically, we have had a large degree of concentration in our corporate sector, and we've seen more attention. I mean, the groceries is a primary example of that. We have lots of independent grocers, but they tend to be quite small. The bulk of your grocery shopping is done in one of a handful of very large national organizations. We see that in oil companies. We see that in banking. Our banking is dominated by a small number of very large banks. Part of it is because we're a relatively small population and we're spread across widely, so that sort of leads to some natural, not monopolies, oligopolies. Part of it's regulatory. If you look at banking, the so-called widely held rule prevents us from having any significant foreign competition into the Canadian market. I think that's helped Canada build an industry to a certain point, but we're a mature economy. I think bring on the competition. Let's create more competition. And the desire and the sense of need to invest comes because you feel threatened. You don't feel threatened if you got an oligopoly and earning high rates of return on equity. But if you did have that competitive thrust, I think we'd see a more ambitious corporate sector in Canada.
I mean, how do you sort of see things unfolding here? Like, things are actually looking okay in a number of different areas. There's always going to be pockets that are really struggling. But are you optimistic, Don?
I am, like everybody else. I worry about the possibility of a second Trump administration, not to be political about it, just purely from an economic ground. We saw what happened the last time around. He slapped on very steep tariffs. He threatened to throw away our free trade agreement, ultimately signed it on with fairly minimal changes. So it wasn't a disaster, but could that be a great deal of difficulty coming through? There's definitely a risk. And again, the Bank of Canada walks across coals when they say anything, but they sort of alluded to that in their risk looking forward. The geopolitical risk didn't explicitly put it in the name of a potential candidate, but that has to be a very real concern for Canadians. Let's face it, we have enjoyed a position of advantage relative to the size of our population in the automobile sector. Would that be threatened? Possibly. We're investing hugely in batteries and electric vehicles. If we didn't have access to that huge U.S. market, that would be threatened.
So are we talking a little bit around the corners of the USMCA or NAFTA, the former NAFTA? How it would
absolutely.
Be looked at? Yeah.
And he didn't. Was it posturing or not? I don't know. As I said, ultimately the proof is it did get re-signed, and while he said it completely got changed to their advantage, I mean, anybody who read the details realizes it didn't get changed in any significant degree. So he got to brag about that. Would it be that again? I don't know. I mean, you worry about things like this.
Yeah. Okay. But there's there's things in the offing, and it looks like we are still in an era of a soft landing at this point. Is that sort of where you would come to?
Well, I was thinking about that just the other day because our nomenclature is soft or hard, and I would like to introduce the term of a bumpy landing.
Okay.
It's neither hard nor soft. It's not particularly soft. If you look at the economy is quite weak right now. And again, I'll come back to that output gap from the Bank of Canada. The unemployment rate's gone up quite a bit. There already have been some bumps along the road, and I think there'll be more. So is it a soft landing? Well, I say, it's that case where you're coming down in the airplane and everything's so quite fine, but it wasn't as smooth as it might have been.
But what I find interesting, one of the things that you're saying with this idea, there's slack in the economy, and there's some room, and we're seeing that, but not a recession.
Well, this is what we talked about the last couple of times. If we talked about output per capita,
Right.
which is what we should talk about, and that's what should lead the Statistics Canada reports and what should lead the analyst reports, we have been in recession for quite some time.
Okay.
I mean, output per capita has fallen 6 of the last 7 quarters. It's down quite a bit. Again, we had 3% population growth over the last year. So having 3% output growth really is nothing, right? That just keeps us constant per capita. For you, for me, for anybody else, it's not the total that matters. What does it do for each people? And the immigration is driving some growth, but not even enough to match the population growth. So I would say if we had the conversation on the right basis, we are in recession and have been for a while.
Okay. Well, then there's only a brighter side to it, hopefully.
Well,
what's your
the
final
Bank of
comment
Canada
here?
is right. We're going to get 2.25% growth. That's not bad.
Yeah.
That would absorb
That
the
is.
population growth.
That would absorb the population. Fantastic. Don Drummond, thank you very much for joining us and helping us understand the rate cut and the cycle that we're in. Appreciate your time always.
Okay, thank you. It's a pleasure.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. You can visit fidelity.ca for more information on future live webcasts, and don't forget to follow Fidelity Canada on Twitter. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments